$79.57. That was the intraday high for silver on December 27, 2025. A number that most financial news networks barely mentioned, buried beneath retail sales figures and year-end market summaries. Yet within the quiet halls of pension fund offices, sovereign wealth management firms, and institutional trading desks across 3 continents, that number triggered something far more significant than a routine price update. It activated algorithms, it crossed thresholds, it sent a very specific signal to the largest pools of capital on the planet. Understanding why that signal matters and what it reveals about the hidden architecture of global finance requires looking beyond the charts and into the machinery that actually moves markets. To appreciate what unfolded in the final week of December 2025, one must first understand the peculiar dynamics of what traders call Ghost Week. The trading days between Christmas and New Year's, when senior portfolio managers are in Aspen, liquidity providers have stepped away from their terminals, and order books run thin as winter ice. In normal markets, prices drift, volume contracts. The world waits for January. But 2025 was not a normal year. Silver opened the holiday week around $71. Within 48 hours, it had ripped through 75, punched through 78, and kissed the $79 handle. An $8 candle in a single session, nearly 6% in one trading day. For a market that typically measures its moves in cents, this was seismic. Year to date, silver had risen 169%, quietly outperforming Bitcoin, Nvidia, and the S&P 500. It had become the best performing major asset on the planet, a distinction that somehow failed to generate breaking news coverage on any major financial network. This silence, as it turns out, was precisely the point. The most consequential market moves often occur not in the spotlight of mainstream attention, but in the shadows of collective indifference. The stealth phase of any major repricing event is characterized by exactly this phenomenon: extraordinary price movement coupled with minimal public awareness. But the stealth phase was ending, and the catalyst was not retail speculation or social media enthusiasm. It was something far more mechanical, far more powerful, and far more difficult to reverse. The gold-to-silver ratio had crashed below 60. To understand why a ratio between two metals matters to institutions managing trillions of dollars, one must first understand how large-scale asset allocation actually works. Pension funds, sovereign wealth funds, university endowments. These entities do not make investment decisions based on intuition or market timing. They operate according to strict mathematical mandates embedded in their governing charters. Their investment committees establish rules, and algorithms execute those rules with mechanical precision. One of the most common rules for hard asset allocation is the historic valuation of gold versus silver. When the ratio exceeds 80, meaning it takes 80 ounces of silver to purchase 1 ounce of gold, the models favor gold. When the ratio drops below 60, the models generate an entirely different instruction. Silver is historically undervalued. Rebalance accordingly. For years, the ratio had languished between 80 and 90. The market appeared to view silver as little more than an industrial byproduct, a forgotten metal with no meaningful monetary premium. Gold captured the safe haven flows. Silver accumulated dust. But with gold trading at $4,500 and silver closing near 79, the math had fundamentally changed. The ratio stood at 57.3. This was not a minor fluctuation. It was a threshold event. When an allocation model sees a sub-60 ratio, it does not suggest a rebalancing. It mandates one. The algorithm interprets the compression as a mispricing opportunity, a chance to acquire monetary metal at a discount relative to its historical relationship with gold. Consider the mechanics of what this means in practice. A pension fund with $5 billion allocated to gold and $0 allocated to silver receives a model instruction: rotate exposure to maintain ratio parity. The fund might sell $500 million in gold positions and deploy that capital into silver. $500 million entering the gold market creates a ripple. $500 million entering the silver market creates a tsunami. The silver market is remarkably small relative to other major asset classes. Annual global mining production hovers around 800 million ounces. Total above-ground investment-grade supply is measured in the low billions of ounces. The market capitalization of the entire silver sector is dwarfed by single technology companies. When institutional capital rotates into a market this concentrated, price discovery does not occur incrementally. It occurs vertically. The traders who remained active during Ghost Week understood this dynamic. They recognized that the ratio signal had flashed on institutional dashboards. They knew that on Monday morning, and especially on Thursday, January 2nd, when full investment committees returned from holiday, allocation orders would begin hitting trading desks. So they front-ran the inevitable. They accumulated inventory during the thin holiday liquidity, positioning themselves to sell that inventory to pension funds the following week at 85, 90, or higher. This front-running behavior explains why $79 felt less like a ceiling and more like a magnet. The market was pricing in future demand before that demand arrived. It was attempting to get ahead of the whale. The pension fund wave, estimated by some analysts at $50 billion in potential allocation shifts, had not yet fully materialized. It was scheduled to arrive in the first trading week of January, when new quarterly mandates kicked in and portfolio rebalancing flows resumed. The question was not whether this capital would enter the silver market. The question was what price it would have to pay when it did. While New York traded silver at $79, a different market told a different story. The Shanghai Futures Exchange, often overlooked by Western investors focused on COMEX pricing, showed the front-month silver contract trading at the equivalent of $84.50 per ounce, a $5 premium on the same commodity. At the same moment in time, in a functioning global market, arbitrage would close this gap almost instantly. Banks would purchase silver at $79 in New York, ship it to Asia, and sell it at $84 in Shanghai. The spread would compress to the cost of transport and insurance, a few cents, perhaps $1 at most. But the spread was not compressing, it was persisting. This divergence revealed something deeply structural about the current state of the physical silver market. Either the metal was unavailable for shipment, the logistics were compromised, or the Western institutions theoretically positioned to execute this arbitrage were unwilling or unable to part with their inventory. The third possibility was the most troubling. If bullion banks were hoarding physical metal to cover their own short positions, they would have no incentive to ship that metal abroad, regardless of the arbitrage opportunity. Their survival trumped their profit motive. For pension fund analysts reviewing their allocation models, the Shanghai premium added another dimension to the trade calculus. They were not merely buying silver at $79. They were buying paper contracts in New York at a discount to the prevailing physical price in the world's largest consumer market. This was the equivalent of purchasing dollar bills for 90 cents. It was, in the language of institutional investing, a no-brainer. Price movements capture headlines. Delivery statistics capture reality. The CME Group's delivery report for December 2025 contained a number that challenged every assumption about how the silver futures market was supposed to function. 12,776 contracts stood for physical delivery. Each standard COMEX silver contract represents 5,000 troy ounces. The math was straightforward but staggering. 63.8 million ounces of physical silver had been demanded in a single month. December is traditionally a transition month. Major players roll positions forward to March. Speculators settle in cash. Volume contracts as the industry prepares for the new year. In a typical December, a few hundred contracts might stand for delivery. Perhaps 1,000 in an unusually active period. Nearly 13,000 was not unusual. It was unprecedented. 64 million ounces represented roughly 8% of annual global mining production, all demanded from a single exchange in the middle of a holiday period. The implications extended far beyond a single delivery cycle. Futures markets operate on a fundamental assumption. The vast majority of participants never intend to take physical possession. They use contracts for price exposure, for hedging, for speculation. Perhaps 1% actually want the metal. But when that 1% becomes 10%, the fractional reserve architecture of the futures market begins to fail. The exchange has sold paper claims against metal it does not fully possess. It relies on the statistical certainty that most claims will never be exercised. When that certainty breaks down, when industrial users, strategic buyers, and institutional allocators simultaneously decide they want the physical metal rather than the paper promise, the system confronts a mathematical impossibility. The registered category of COMEX vaults, the metal officially warranted and available for immediate delivery, had been declining for months. Withdrawals from major vaults had accelerated. The cupboard, as insiders described it, was approaching bare. Where would 64 million ounces come from? The answer was uncomfortable. Leased metal, borrowed inventory from ETF holdings, emergency sourcing from Swiss refineries. The banks would scramble, they would pay premiums. They would hemorrhage cash, but they would have to deliver, because the alternative, force majeure, an admission that the metal simply did not exist, would constitute the end of the current pricing mechanism entirely. What most observers missed in the final week of December was not the price spike or the delivery surge. It was the signal embedded in the Federal Reserve's repo facility data. $17 billion injected into the system on the morning of December 27th. The mainstream interpretation of repo operations focuses on mundane mechanics, short-term liquidity management, technical plumbing of the banking system, routine operations that keep markets functioning smoothly. But the timing of this particular injection was anything but routine. When bullion banks face delivery demands for metal they do not possess, they must acquire that metal in the open market. Acquiring metal requires capital. If their short positions are bleeding value, they face margin calls. The silver market had become a black hole for liquidity, absorbing billions of dollars per day from institutions that had positioned themselves on the wrong side of a physical shortage. The repo facility exists precisely for moments when banks find themselves cash constrained. It allows them to pledge collateral, typically Treasury securities, in exchange for short-term liquidity from the Federal Reserve. The size of the December operation suggested something more concerning than routine liquidity management. It suggested that one or more systemically important institutions had encountered stress significant enough to require emergency intervention. The connection between silver delivery demands and broader financial stability was not immediately obvious to casual observers. But the architecture of modern finance makes such connections inevitable. Banks do not operate in isolation. Their commodity trading desks are connected to their treasury operations, which are connected to their derivatives books, which are connected to their prime brokerage relationships. A margin call in one division affects collateral availability across the entire institution. If a major bullion bank, a global systemically important bank in regulatory parlance, were to default on its commodity obligations, the ripple effects would extend far beyond the precious metals market. Counterparties would freeze, collateral chains would snap, the clearing system would seize. The Federal Reserve, monitoring internal risk dashboards, had apparently seen something that warranted intervention. Whether that something was directly related to silver positioning or merely correlated with it, the timing was suggestive. The Fed had, in effect, placed a floor under the banking system's ability to survive a commodity squeeze. By providing liquidity, it enabled the banks to continue operating, to meet margin calls, source physical metal, and roll positions forward. But this intervention created its own perverse dynamics. Printing money to bail out short positions in a physical commodity does not create more of that commodity. It simply injects more currency into a system chasing a fixed supply of real assets. The intervention that saved the banks today would devalue the dollar tomorrow, which would push commodity prices higher, which would require additional intervention. This was the doom loop. The Fed had chosen to sacrifice currency stability to preserve institutional solvency. It was the same choice central banks have made in every crisis since the abandonment of the gold standard. But each iteration of that choice eroded the foundation on which the choice was made. The events of late December did not occur in a vacuum. They occurred against a backdrop of escalating geopolitical tension, particularly in the strategic waterways that connect global commodity flows. Venezuela's announcement of an expanded naval blockade in the southern Caribbean had immediate implications for the shipping lanes that carry energy resources, refined metals, and industrial inputs to North American and European markets. Insurance premiums for vessels transiting contested waters had increased dramatically. Some shipping companies had begun routing around the affected areas entirely, adding days to delivery schedules and costs to every cargo. For a market already experiencing physical tightness, any additional friction in logistics represented a compounding stress. Silver refined in Latin America, bound for delivery to COMEX-approved vaults, now faced uncertain transit times and elevated insurance costs. But the geopolitical dimension extended beyond immediate supply disruption. Sovereign wealth funds and state-owned enterprises, particularly in Asia and the Middle East, were drawing conclusions from the repo market intervention. They observed that the American banking system required emergency liquidity support when confronted with a relatively modest commodity squeeze. They noted that the Federal Reserve had chosen money printing over market clearing. These observations informed their own strategic positioning. If the dollar's purchasing power would be systematically eroded to protect institutional solvency, then accumulating real assets, physical metal, energy reserves, productive land, became an increasingly rational response. The buying pressure visible in the Shanghai premium reflected this calculation. Chinese industrial demand for silver was genuine. The solar panel industry, the electronics sector, the emerging battery technologies all required physical metal. But layered atop that industrial demand was strategic accumulation by entities that viewed precious metals as a hedge against dollar devaluation. Every central bank intervention designed to stabilize the financial system in the short term sent a signal that encouraged foreign accumulation of real assets in the long term. The Fed was, inadvertently, incentivizing the very capital flows that would further tighten physical commodity markets. Markets exist in a perpetual tension between the present moment and the anticipated future. The price action of late December was not merely a response to current conditions. It was a forward-looking calculation about what January would bring. The first trading week of the new year would introduce several reinforcing pressures. Institutional trading desks would return to full capacity. Portfolio managers who had left for the holidays with silver at $72 would return to find it knocking on $80. Their allocation models would be screaming for rebalancing. Their clients would be asking why they had missed the move. Career risk would compound fundamental positioning. In the institutional world, underperforming one's benchmark carries severe professional consequences. If silver was up 170% on the year and a fund had zero exposure, that fund's managers faced uncomfortable conversations. This meant the buying pressure in early January would not be purely rational. It would include an element of panic, career preservation dressed up as investment discipline. Managers would chase the trend not because they had independently concluded silver was undervalued, but because they could not afford to explain to their boards why they had been on the sidelines. The new quarter would also activate fresh mandates. Strategic commodity allocations that had been pending approval would be funded. Mining sector exposure that had been discussed in Q4 committee meetings would be executed. The capital that had been waiting on the sidelines would enter the arena. Into this environment would come the accumulated stress of the delivery cycle. The banks that had been scrambling to source 64 million ounces in December would face continued pressure. Their short positions, if not covered, would bleed further as prices rose. Their need for Federal Reserve liquidity would persist. The setup contained all the ingredients for extreme volatility. A market that had moved too far, too fast, during thin holiday trading would collide with returning institutional capital, persistent physical tightness, and mounting bank stress. The outcome was not predetermined. The banks retained tools, paper leverage, coordinated selling, the ability to trigger stop-loss cascades among over-leveraged retail traders. They might attempt one final price smash, a dramatic intraday reversal designed to break speculative psychology and buy time to cover positions. But the fundamental imbalance remained. 64 million ounces of delivery demand, a 57 ratio screaming undervaluation, a $5 Shanghai premium proving physical scarcity, a Federal Reserve already forced to intervene. The path of least resistance pointed in only one direction. In the end, the events of late December 2025 were not really about silver. They were about the gap between paper promises and physical reality. They were about what happens when financial engineering, layered over decades upon a foundation of fractional reserves and leveraged claims, finally collides with the irreducible constraints of the material world. Silver cannot be printed, it cannot be conjured by central bank policy, or expanded through balance sheet manipulation. It exists in finite quantities, distributed unevenly across the Earth's crust, accessible only through capital-intensive extraction that takes years to bring online. The financial system, by contrast, can create claims against that silver instantaneously. Futures contracts, options, derivatives, ETF shares, all can be issued with nothing more than a keystroke and a willing counterparty. For decades, this worked because nearly everyone treated the claims as equivalent to the metal. They traded the paper, they rarely asked for the physical. But equivalence is a fragile assumption. It holds until it doesn't. And when enough participants simultaneously decide they want the metal rather than the claim, the architecture designed to manage that claim collapses under its own weight. What unfolded in late December was a stress test of that architecture. The delivery demands were probing the system's limits. The ratio signal was activating capital flows too large for the market to absorb smoothly. The repo intervention was patching over stresses that would otherwise have become systemic. The outcome of this stress test remained uncertain. The system might absorb the pressure, adjust, and continue functioning. Or it might fracture in ways that forced a fundamental repricing of the relationship between paper claims and physical metal. Either way, the signal embedded in the data was clear. The rules that had governed commodity markets for decades were changing. The assumptions that had held for a generation were being challenged. The participants who understood this shift, who recognized that the physical world was reasserting its primacy over financial abstraction, would navigate what came next. Those who did not would find themselves holding promises that no amount of Federal Reserve intervention could ultimately fulfill. The markets would reopen on Monday. The institutions would return, the algorithms would execute, and the metal would continue doing what it had always done, existing in precisely the quantity it existed in, indifferent to the claims made against it, waiting to be discovered by those willing to look beyond the screen price and into the vaults themselves.